Document storage and handling business Metrofile holds in excess of 21 billion records on behalf of clients. With a surge in regulatory red tape, this number is set to keep on growing. For the year to June, Metrofile reported a one-quarter rise in normalized headline earnings per share and has paid a maiden dividend. Richard Buttle is Chief Financial Officer at Metrofile. Welcome, Richard.
Thanks, sir.
Congratulations. I see it closely followed by small cap analysts and investors. So now, issues of market share aside, if you look at the regulatory issues to which I referred, this is presumably playing in your favour.
Absolutely. I mean, there's just, for example, there's the Protection Act, New Companies Act, Protection of Personal Information Act, which obviously hasn't come into play yet, but is looking like it's coming. It's all around confidentiality, it's all about record keeping, it's all about good governance, and really talks to our business model.
Are you getting the lion's share of the business? So you are the leading market player. How difficult is it for other players to enter the market given the opportunities?
I think there are other players, there's no doubt, and you can get in at a small scale if you want to do it properly. It's a big business and it's expensive capex, especially on the records management side, on the physical storage side. Risk mitigation is expensive and necessary, and with corporate clients you can't take that lightly either. So we will make sure we satisfy what we're doing for our clients.
So just talk us through the business model. So it's storage, it's scanning, and just various risk management, as you say.
Yeah.
If you've got the facilities built, the marginal cost of taking on more volume presumably fairly low up to a point?
Yes, yeah. I mean, obviously racking we do in phases from a capex view. Like to just fully rack a warehouse depending on the size, so we look at efficiency there. Once from a staffing point of view, there's a lot of efficiency once you get going in a facility. Location makes a difference. If we extend on existing premises, obviously it's easier than if we are on an alternate premises. But yeah, it is a numbers game, it's a volume game, so the bigger you get, the easier it is to get efficiency out of it.
You said it's a volumes game, but your margins look good too.
Absolutely, yeah. I mean, we keep on pushing to try and achieve better margins at the same time through efficiency and also fair pricing to our clients. So it's a challenge to do that, but it's possible.
You refer to third-party facilities being custom-built to your specifications. So what proportion of your facilities are owned and rented? Currently
it's 60% owned, 40% rented. That includes CSX brand, for example, which is quite a different business, so they don't use warehousing. We've decided we're going to be between 40 and 70% owned. We always wanted all our own premises, and we've done a lot of modelling on it, and it's just not cost effective long term. It's big capex, and we want to be able to move if things change. So if the volumes change on the paper side and scanning grows, we're not going to be committed to all specialised buildings.
So it's a cost consideration. Over time then you're going to increase your rented facilities?
Yeah, but it depends. We take each one case by case. It very much depends what's out in the market. I mean, the last couple of years has been opportune to pick up some good rentals, and as long as the height there, for us the height is a big issue on a warehouse. If we can get the height on a warehouse, then we get efficiency in it. For example, our Pretoria warehouse is 20 metres high. You won't typically find a warehouse like that, but if you can get 9-10 metres on a normal rental, it's not bad. So it depends what's out there, what the rates are, what the lease terms are. We'll look at the combination.
An important theme, I think, for you over the past year, if not more, is Africa expansion onto the continent. You're already in Mozambique, and the Nigeria is probably the next big market, after South Africa. What's the progress there?
Yeah, it's been very slow. It's been frustrating, and I think probably frustrating to some of our shareholders, but I think they also understand where we're coming from, where we've come from in the past in terms of debt and risk, and so we're taking a cautious approach on it. Nigeria was slowed down by us having to change our strategy on partners. We finalised with a new partner now, and we believe going forward we'll really progress now. Once we get Nigeria in play, we think the others will follow fairly quickly, and we're looking at the Ghanas, the Kenyas, or Uganda, those sort of countries to follow from that.
So the model is a partnership one?
Yeah, absolutely, yeah.
Why that? Is that risk mitigation?
Typically local partners required. We've taken the approach that we've got a partner in play that's not going to be local. They'll be a local player, but they're not local as in each country a different partner. So that's why we think it'll be a lot quicker, because establishing the partnership is what takes the time.
And yet, you want someone with a local footprint, but on the other hand, what I see is that you're going alongside South African companies Africa. I think, for instance, Standard Bank. So that also reduces risk.
Absolutely. I mean, that's why we started looking at it in the first place. So we had Standard Bank approach us, Citibank. I mean, there's several clients, MTN, there's numerous people out there that we can follow or assist. And so the business model's fairly obvious. There's nobody really doing it in Africa. Most people are doing things themselves, putting things in warehouses. They're not doing it properly. And we need to do it at the correct level. So that's nice for us from that point of view, because the market's there, there's no doubt.
Can't help thinking, a layman's question, if you've got competing companies both storing with you, there are no concerns on their part that there might be a swapping of boxes?
No, I mean, overseas, for example, in Nigeria, that question's come up, and we probably had that question 10, 15 years ago here, and we store for all the banks. There's so much volume, it's barcoded, it's tracked and traced. It's not something that somebody's going to tap into and get confidential information. On
a more serious note, you referred to gearing earlier, and I think now you can talk about gearing, because you've come in below 100% now. 3%, so what's your target gearing level?
We don't have a specific target. I mean, I think from where we've come from, I think 4 years ago it was 400-odd%. It came out of the legacy debt that we had, so it wasn't self-inflicted. But I mean, I think looking a year ahead, we'll probably get close to the 50% mark. And the bottom line is we've got choices now with the cash that we're generating. That's why we're doing the dividends. We're not stuck to just paying loans and hoping to be able to do the next instalment, which is where we were a few years ago.
The expansion that you are considering, then how would that be funded?
At this point, I mean, the Nigerian expansion is not an expensive one, so we're going to be looking at out of our cash reserves. And then any other expansion, acquisition related, will depend on the acquisitions. As part of our strategy also to look at acquisitions. They must be aligned to our business, not necessarily mirrored of what we're doing. And depending on the value, we'll look at cash or shares or combination.
Right. And so you say you've got options with this great cash generation. I forget, it's sort of 12%, 15%?
It was a 15%. 15.1 now.
So you've paid a maiden dividend now, so rewarding these very patient shareholders. And I think that must be a really difficult decision, because this is a signal, right? Once you declare a dividend, you have to keep up.
Yeah, I think so. I think, look, we term ourselves a defensive business or non-cyclical, which obviously the con to that is that we won't have the 40-50% revenue growth in 1 year, but throughout the bad times we've grown every year without fail. So with the annuity base of that, we're quite confident that it's sustainable and we will deliver on that.
So what's the ratio then? What's your dividend ratio?
At the moment it's 4 for our first year, 4 times cover, and we're aiming for 3 times cover.
Prospects then, it's so nice in this environment to read company prospects that look optimistic. So just talk to us about that.
I think, I mean, any environment's tough at the moment. There's no doubt we're seeing the opportunity for us is we've got a lot of products, a lot of services. It's the cross-selling of those. As I mentioned earlier, good governance is what it's about. Good record keeping goes with that. So our business is for that. And so we see that we'll continue to grow in all levels, the revenue, the EBITDAs, right through to the bottom line, the earnings and the dividend.
Richard, thanks very much.
Thank you.
Good talking to you. That's Richard Battle. He's Chief Financial Officer at Metrofile, the storage business.